and welcome. In this explainer, we're going to get to grips with a really important part of the new Income Tax Act 2025. We're talking Sections 64 and 65. Now, these sections give us a clear roadmap for what to do with tax deductions when cooperative banks merge or reorganize. Honestly, understanding them is absolutely key for a smooth transition. So let's get right into it. So let me paint you a picture. Imagine a co-op bank merges with another one, right in the middle of the tax year. And there's a big tax deduction on the table. How do you handle that? Who gets to claim it? Is it the original bank, the new one, or do they somehow split it? You see, this isn't just a textbook question. It's a real-world challenge that needs a precise, legally solid answer. And to get to that answer, here's how we're going to break it all down. First, we'll dig a little deeper into this whole reorganization puzzle. Then, we'll unpack Section 64, which is the legal solution, and look at the exact formula it gives us. After that, we need to define some key terms from Section 65, put it all to the test with a case study, and then we'll wrap up with the must-know compliance points. Okay, so first things first, let's really frame the core problem we're trying to solve. The uncertainty that comes from a mid-year reorganization is exactly why these provisions were written into the law in the first place. Think about it. A reorganization halfway through the year basically cuts the tax year in two. You have one entity before the merger and a different one after. So without a specific rule, how do you decide who gets what deduction? It becomes really ambiguous, and that can lead to all sorts of problems. That's why the law steps in to provide a clear, fair, and logical way to split it. So, where do we find the answer to all this confusion? Well, look no further than Section 64 of the Income Tax Act 2025. This is the specific legal tool designed to bring clarity and fairness to these exact situations for cooperative banks. You know, the whole point of Section 64 is to take all the guesswork out of the equation. It's designed to replace any ambiguity with a straightforward mathematical formula for dividing up those deductions between the predecessor, that's the bank before the reorganization, and the successor bank that comes after. So let's break this down a bit. What's the objective? Simple, fairness, to make sure everyone gets their fair share. Who does it apply to? Specifically, cooperative banks going through what the law calls a business reorganization. And how does it work? Well, the mechanism is actually pretty elegant. It's a formula based on time, splitting the deduction based on the exact number of days each bank was in operation during that tax year. Okay, theory is one thing, but how does this time-based split actually work in practice? Let's get into the nitty-gritty and look at the actual formulas that make this apportionment so crystal clear. So for the predecessor bank, the original one, the formula is pretty simple. It's A times B divided by C. A is just the total deduction available for the whole year. B is the number of days the bank was running before the reorganization. And C is simply the total number of days in that tax year. It's a very straightforward calculation. And for the successor bank, the new or surviving one, the formula follows the exact same logic. It's A times D divided by C. A and C are the same as before. The only thing that changes is D, which is the number of days the new entity operated after the reorganization. This ensures the total deduction is split perfectly between the two. Now, this is absolutely crucial, and it's something people often miss. This isn't just about the year of the merger. Section 64, subsection 3, is all about continuity. It says that for some of those ongoing multi-year deductions, the successor bank literally steps into the shoes of the predecessor. It can keep claiming those benefits in future years, just like the original bank would have. It's a huge deal for long-term stability. Okay, so to use these formulas correctly, we have to speak the language of the law. And that's where Section 65 comes in. I want you to think of Section 65 as the official dictionary. It gives us the precise legal definitions for all the key terms we're using in Section 64. First up is the big umbrella term business reorganization. Section 65 tells us this means any event that involves an amalgamation, a demerger, or the conversion of a primary cooperative bank. So this definition really sets the stage for when Section 64 even applies. The most common one you'll see is amalgamation, and the act is very specific here. It's a merger where all the assets and all the liabilities of the old bank get transferred over to the new, surviving bank. No ifs, ands, or buts. Next, we have demerger. Now, this one's a little more complex. It's when a specific part of a bank's business, what the law calls an undertaking, is transferred to a different bank.
And for it to legally count as a demerger, a whole list of specific conditions has to be met, like transferring assets at their book value. All right, enough with the theory and the definitions. Let's make this real. Let's see how all this plays out with a simple, practical case study. So, here's our scenario. We have Bank P merging with Bank S, and the magic date is October 1st, 2026. The tax year has 365 days. And just to keep the math simple, let's say the total deduction for the whole year, our variable A, is a nice round 365,000 rupees. 1,000 rupees per day. Easy. So as you can see, Bank P was in business for 183 days, from April 1st right up to September 30th. So its deduction is 183,000 rupees. Simple. Bank S then takes over for the rest of the tax year, which is 182 days. So it gets the remaining 182,000 rupees. The total 365,000 is split perfectly, fairly, and logically based on nothing more than time. Okay, so we've walked through the law, we've gone through a practical example, now let's bring it all together. We'll finish up by focusing on the absolute essentials, what you need to do for compliance, and the most important takeaways from all of this. When it comes to compliance, it's all about precision. You have to keep clear official documentation of that reorganization date. Make absolutely sure your day counts for B&D are accurate. Honestly, one of the most common mistakes is getting the effective date wrong. And finally, don't forget to look ahead. Always assess those carry-forward benefits for future tax years. Now, for those of you who've been around the block and are familiar with the old 1961 Act, this whole setup should feel pretty familiar. Section 64 in the new Act is basically the direct successor to Section 44DB in the old one. The core idea, that time-based split, is exactly the same. The main difference is just a change in words. The new Act uses tax year instead of financial year, which is a change they made across the entire Act to simplify things. All right, so if you remember just 4 things from this explainer, make it these. First, Section 64 gives us a clear, non-negotiable formula based on days of operation. Second, Section 65 is your go-to dictionary for all the legal definitions. Third, and this is a big one, the successor bank inherits future benefits, which is all about continuity. And finally, the whole reason this framework exists is to make tax transitions during reorganizations fair, logical, and predictable. Thank you so much for watching. If you found this breakdown helpful, it would be great if you could like, subscribe, and maybe share it with your colleagues. This video is for educational purposes only and does not constitute professional advice. Tax laws are subject to amendments. Please consult your professional advisor before taking any action. This is an AI-generated educational video.